Welcome to the Live Squawk podcast, where professional traders, investors and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Before we dive in, if you want the news that moves markets delivered in real time, 24 hours a day, check out Live Squawk. It's our audio squawk service trusted by serious traders worldwide. Start your free trial today at livesquawk.com. No credit card required.
Hello and welcome to Live Squawk's Market Talk. This is our week in focus, and it's recorded on Friday, the 3rd of July, 2026. For anyone new to this, it's our weekly briefing, which aims to break down the key stories from the past week and explore the subsequent implications for the markets. We'll also take a look at the week to come, giving you a heads up on the events and data points to watch out for. There's a lot to get through this week, and for me, to help me get through all this, I'm joined by a regular contributor. He hasn't been on for a while, but Jamie Dutta of PIQ. We'll bring Jamie in a minute. But just a quick disclaimer here for those new. Anything that we say should be taken as market talk and not in investment advice. But just for the sake of clarity, the content provided on this channel is for informational and educational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial, investment or trading advice. Please conduct your own research and consider your financial objectives. Consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And with that, we shall crack on. Good afternoon, Jamie. How you doing?
Hello, Harry. I'm very good, thanks. Very good indeed. Thanks for the invite, as always, and trying to not enjoy the sunshine too much, as there's a lot going on. So, yeah, great to be here, as always, Harry.
Yeah, we say there's a lot going on, but we're recording this on Friday, as I said, afternoon. US markets are shut the day ahead of Independence Day. So in terms of action this afternoon, there's very little, but there's been a lot out to sort of take in and to try and get through on different levels. So we want to look back really at, and so listen, happy 4th of July to my American friends and listeners. And for those non-American listeners, meh, there we are. It's just another day. But here we go. Don't
250 years, Harry, come on.
250 years, yeah, but for the English, that's 250 years of hurt. Nearly as long as since we won the World Cup. So we'll leave it there.
No.
But to get into the reads here, we did, because of today's holiday in the US, we did get the monthly non-farm payrolls data out a day early. Quite unusual, but we got it out on a Thursday rather than the normal Friday. And we saw some weakness in the number itself that maybe surprised a few. I think the consensus was for 115,000, and we came in at, was it 57,000 on the month for June, yes. Which was a surprise. But we did see the unemployment rate fall to 4.2% from 4.3%. More of a rounding thing, I think, than anything else. But nonetheless, it went in. It went down rather than up, and was noted as such. And I think services was one of the standout sectors that lost jobs, which I was a little bit surprised about because the World Cup and everything going on in North America and Central America at the moment might have said differently, but that's what it was. What were your initial views of what we saw yesterday?
Yeah, I think broadly, I suppose it's a single print. We always have to remember that. So it's obviously the first disappointing print in 3 months, I think, less than 100,000. So I think that's worth bearing in mind. Kind of risk assets took it as bad news is good news, really. Sort of Goldilocks type print, not too hot, not too cold. Obviously, jobless rate coming down for certain reasons, really because of that participation rate coming down, which isn't a great sort of reason for economists because people are leaving the workforce, basically.
Just on the record, that was 61.5% for the participation rate from 61.8 previous and 61.8 expected.
Yes, exactly. So, yeah, sort of not too hot, not too cold. I think for policymakers, for Walsh, buys them time, right? And the FOMC, it buys them time. I think, the price hikes that we were seeing getting priced in, nearly 2 sort of hikes for this year, that's obviously come off. It takes the pressure off policymakers, really. Takes the pressure off Walsh, really, as the new, incumbent, really. You have to say that. And we talked about some of the task forces that he's obviously implemented, and they'll take time to get some results and then them act on those. So I think, this all helps Walsh, really, at the end of the day. Sorry? Yeah, time.
Buy them time.
Absolutely, yeah. And it's a sort of reality check. I think somebody put it out there about that being, their now focus is on inflation. As long as the labour market is behaving sort of give or take, is not too hot, then definitely it gives them time. I think it's interesting, a couple of points in amongst the detail. It sort of follows a pattern. If you look at 2024, 2025, average March to May was around 124,000 and then 34,000 in June. So are we seeing that again, this sort of softness sort of mid-year? And if you remember, actually back then, there was an insurance cut in September 24. Obviously, now we've been pricing in this insurance hike September 26. So, yeah, just sort of interest there. Otherwise, I think, as we mentioned, this participation rate falling, and then there's just questions around the labour force. So, does that mean that's because there's not enough labour supply, or does it mean there's not enough demand for labour? So those sort of, probably jury's still out on those sort of questions. I think people want to hire, really, but the labour force is not there to hire, really. So yeah, a lot of questions around that, I think. Otherwise, go on.
Yeah, I was just saying, to sort of sum it up then, hiring intentions on the softer side, but layoffs still aren't really exploding. And again, we haven't touched upon wage growth too much, but that was easing as well. So as you said, it buys time, because ultimately this hot running, I'd say it's a solidly running economy, US economy, isn't at the levels that you would call traditionally overheating if you take out the energy and the recent spike in oil prices that we are now seeing, hopefully abate.
And I think, just to add to that, Harry, if you look at other labour market data, it's not great, right? It's weaker. And that's what we've all been waiting for, these weak NFP prints. And then obviously we have a 3-month hot streak in a way. So, consumer confidence labour market index dropped to the lowest level since, I think, when was it, post-COVID period, 2021, and then there's been other, bits of data, the household survey data we sort of mentioned, but that big drop of over 700,000, right, in the labour force. So, it's slightly odd that we have those, stellar 3 months, and now we're sort of getting back to reality potentially. And you've seen that in the sort of 3-month averages, right? I think it was like 188,000 before the data, and now it's back to sort of 111, And if you think about the sort of that break-even rate, I think it's St. Louis Fed, isn't it? Sort of 15 to 87,000 or something like that spread, So that's still going strong, even with a 57 print. But we did get those revisions as well, over the last 2 months, 74,000, I think. So
a drop of 74,000 from a previous 93,000.
And I think just on that detail as well, quite interesting. You mentioned about services. So private education and healthcare, they were a source of strength, and they've sort of been about 70% of all jobs created since 2022, December 2022. So that's a lot, in one sector. Then we have that leisure and hospitality. They've been strong as well in recent years, but then not in June. And everybody's like, oh, well, what's happened to the World Cup boost? But we saw that probably in May, right? So, and whether there's seasonals around that as well. But I think it was the biggest drop in that sector since like December 2020. So, and those aren't the sort of traditional sectors which, you associate with a very strong economy. They're sort of part-time temporary roles. So, quite interesting sort of detail, I guess, as well.
Yeah, and you know, taking the number on its own. I mean, I've got a note here from Deutsche Bank which backs up a lot of what you said. They said, in short, the June employment report was more noise than signal, and Fed officials will likely treat it accordingly. More importantly, the broader constellation of labour market data points last week, such as the May jolts, ADP, and jobless claims, continue to paint a picture of stability, albeit with a still uncomfortable equilibrium between low hiring and low firing. So everything you said there in a paragraph. Right. We'll come back to the US when we look at the week ahead and what we have next week. But I want to look now across the pond to the euro area, the Eurozone flash inflation report, which was a softer than forecast rise, which might suggest ECB went too early. That's the suggestion I'll put out there. We saw the headline year over year coming up. Was it 2.8%, which is below many forecasts. And really, it kind of, I'm not going to say made a fool of the ECB for cutting rates last, back in June, but it kind of asked and people were asking the question before then, was it necessary for to hike rates? Was it necessary for the ECB to hike rates last time out? So that's again soft print, which was awkward timing for the ECB. And as Annie said, it raises the question: did the ECB move too soon? Markets were already questioning how much tightening was really required, and this won't help the ECB's credibility in some senses, I don't think. Although I didn't really hear too many people objecting too vociferously ahead of the last meeting, and subsequently when they actually did hike rates. And also, obviously, the timing of the agreement between the US and Iran, I think it was known, it was being mooted anyway, so it wasn't as if it was a massive surprise that tensions had eased to a degree anyway. Do you think, I mean, I've asked many guests this in the past couple of months, leading up to the hike and subsequently. Do you think it was a mistake?
Was it a mistake? In one word, yes or no? I think yes, but I think it's understandable. And we've talked about this before, just with the history of the ECB, with the history of the Bundesbank, going way back, decades back, and they're wanting to show their, credibility around inflation fighting way back decades ago. The Bundesbank, as I say. And then even now, I think actually, when I was sort of looking around a few things, just the transitory word, right, which nobody can mention for obvious reasons, but in this case, and you say, we had the mentioning of the MOU, and the timing was slightly tricky for them. But I think when you put that all together, even just those couple of factors, very strong factors with ECB decision making, then I think that's why they took that decision. We'll see whether it's right or wrong. I mean, I know you and me have followed European interest rates for quite a long time as well. And we're always wary and pointing the finger that they've made a mistake because they've got a history of that, in the 2010s and so forth. So I think if I'm on their side, then potentially, you've got still potentially a pickup in inflation over the coming months because there's lots of energy subsidies which probably expire, I think, at the end of June. So whether that sort of, keeps inflation elevated. Otherwise,
that's a good point. Germany's subsidy ends at the end of June, and
right.
They make up 28% of that euro area HICP. So
yes. And I think, as much as oil, and we're all looking at oil and we're all saying now it's back to pre-war levels, you've got question marks still around the fragility of it all in the 60-day MOU. And I think as well for the ECB, it's not just oil, right? It's LNG especially. So I think, those prices are still sort of 40% above pre-conflict levels. And the ECB Governing Council look at that when they're assessing inflation risk in Europe. So, it's not just oil, and that's come down, and therefore, it was a mistake, should we say, because there are obviously other things, especially LNG, which is still elevated. So I kind of understand it, but then we have seen, leading in maybe to Lagarde, obviously it's Sintra, sort of slightly backtracking of sorts, I think, and we're probably going to get into that, aren't we? I guess.
We are. Yeah, we are. We can do it now, really, because it leads. Like you say, it leads really comfortably nicely into the ECB conference. So just let's put the Eurozone bit aside. So energy was still the main driver of the gains, but decelerated to around 8.7% from 10.8% in May. Services, as you know, cooled, shaving sort of 3/10 to hit 3.2%. Food, alcohol, tobacco were 1.6% down from 1.9. So we saw a general cooling in some of those major areas, really. Non-energy industrial goods were at 0.9%, which was stable compared to May. And on that core reading, if you take out energy, we saw a rise of energy and food. We saw a rise of 2.4% compared to 2.5 last.
I think just say, Harry, sorry, just quickly. Then it is interesting leading into that, and then we're kind of now in the ECB's milder scenario, right? So these scenarios that Walsh is trying to get away from, I guess, and now the ECB have introduced them, which is a classic. But we're sort of more closely aligned probably with that, right? And I think in June they said headline would be expected at 3.2, we're at 2.8, but then core would be 2.4, and we're at 2.4. So I think then looking ahead, do we get a downward revision in September to the inflation forecast? That would probably make it a little bit tricky if they're hiking rates then, potentially, or do they just leave the door open and say, hawkish bias, and that's what we're doing? I know Lane, right, the chief economist, he's been in that camp, really, just citing still second round inflation effects, of course, and then the top of the range of the neutral policy rate, I think, he said should be raised to 2.5%. So, I think still, very much, data dependent and sort of a little bit of time on their side as well.
Yeah, it's something I mentioned in the reaction piece I wrote following the decision itself. I mean, she actually did defend June's rate hike. She pushed back against the idea that last month's quarter point move was an insurance hike and argued that it was fully justified by the ECB's inflation projections at the time, which was consistent with what she said in Sintra. And it wasn't precautionary, it was a necessity, according to really, if you take what she said. She also acknowledged that falling oil prices and de-escalation in the Middle East have made both inflation and growth risks a bit more balanced versus a few weeks ago, which is a notable softening from the June meeting when inflation risks were clearly sort of skewed slightly higher. But all this in place, and bank research suggests this weakens the case for a July follow-up hike, which was fairly well priced in. I think immediately after the Eurozone data, we priced out a hike to something like 23 basis points worth of hikes until year end.
Yeah, I think September sort of 50-50, a little bit touch above that. So it kind of seems right, and they can watch the data coming in right ahead of that decision. And then the new style projections, of course, as well.
Absolutely. And again, she gave an interview, I think, at the conference as well. And she argued that Europe was structurally a bit more resilient. And ultimately, they could be a bit tougher, I guess, because there are stronger banks, deeper capital markets, better policy tools, meaning the ECB can react to shocks without triggering fragmentation or systemic stress, is how it was termed. So again, it gives them that little bit more leeway to act and not have to regret the move down the line. But,
one and done then. One and done.
Yeah, I mean, I was talking with someone that said potentially there was room for a reversal. I think it was a couple of episodes ago. I don't know if we'll get a reversal, but in this sense, yeah, one and done seems to be where we're at with that. Yeah. Moving on then, and we can come back to this at that point. But UK politics, it's been another bit of a sort of hotbed in recent weeks, and it hasn't done any favours for UK securities. The question I ask here: what does the transfer of power mean for UK markets, and how to fill the defence hole? Do you see more disruption for UK securities, and is it going to be harder to trade confidently in UK assets in the near future, or invest in UK assets in the near future until we're a bit more settled on the political front?
Interesting question. UK securities, if you mean sort of stocks, right?
Yeah.
You know, UK FTSE 100 hits highs it hasn't seen since March, you know, today, actually. So, you know, FTSE, as we know, FTSE 100 defensive, lots of overseas companies in sort of old school industries compared to, you know, NASDAQ, tech heavy, every industry going across the globe, it seems. Yeah, Kospi, Nikkei, 225, NASDAQ, S&P, of course, as well. So, you know, if you want some cover from tech, from semis, and how strong they've been, then, you know, UK FTSE is doing pretty well. And it's sort of abstract from domestic politics, I would say. If we're talking about, obviously, then sterling gilts, then yes, I think interesting. Doomsday hasn't happened. You know, I think it was really interesting. Wes Streeting was the favourite to be next Chancellor a couple of weeks ago. It flipped on its head overnight, virtually, as far as I could tell. You know, betting markets, poly markets. Then all of a sudden, Ed Miliband, strong favourite. And what happened to gilts? What happened to sterling? Not a great deal, actually.
No.
And I think, you know, I've been consistently talking to you through the months, if not years, actually, about this. And you know, so many people being so doomsday-like, if you like, on the UK, whereas we're actually holding up okay. And I think that's the same with Andy Burnham, I would say, and who he brings in. If you look at his advisors, supposed advisors at the moment, Jim O'Neill, ex-Goldman
Very
Sachs.
sound. Yeah.
He's not a socialist. James Parnell, he's a Blairite. Well, he was, you know, back in the day, young chap. Now he's obviously got up a bit older. He's probably not a socialist. Andy Haldane, BOE. If you listen to anything he said recently, and I've listened to some cracking podcasts with him on, he talks a lot of sense, and he's not a socialist. So, you know, I think we have to bear that in mind. Obviously, things can change, and that's just what's being told in the press, whatever. As for the man himself, I do like a quote, and it's not a podcast I've listened to, but it was with Ed Balls and Osborne. I don't listen to it myself, but somebody else referred to it in a podcast I do listen to, and they said, "Oh, what's Andy Burnham like?" And he's apparently a very good footballer, right? He's an Evertonian, loves football.
Is he?
Yes, he plays on lots of, you know, MP teams, whatever. And he was playing with Ed Balls back in the day when he was in the Treasury. And they said, "Oh, where I'm ad-libbing here," but they said, "Where's Andy?" He said, "Well, he's either far left or he's on the far right. We're not sure." So I think, you know,
they've been on the pitch.
he probably scored a goal, you know, and then just went, right, there he is in the centre. I think, you know, so if you could take that with a pinch of salt, I kind of think, you know, look at the time frame. So July 20, I think, is the prospective date, isn't it, when he gets appointed? Then we're all obviously looking at the Chancellor, but still a strong favourite, I think, Miliband is. And then we get sort of lots of speculation around sort of late summer into probably the first budget, which will be November, late October. Right. So, you know, at the end of the day, I still think, you know, the good old bond vigilantes will mean, you know, there is not a lot of room for manoeuvre. But
they'll hold them to account. They will hold the new government and the Treasury to a new government. It's the same government, but in terms of new leadership to account. You know,
exactly. Exactly. And I think the defence plan. Sorry, just to finish off, the defence plan. You know, what I heard is that basically, obviously, the UK can't afford very much, and they're waiting for interest rates to come down to then try and spend more. And if you think, then Andrew Bailey is probably waiting potentially for that, and they have some time to act. They don't need to hike probably, but then if cuts get priced in, then I guess everything gets a bit cheaper, right? So, yeah, that would be sort of, you know, my take on it at the moment.
Yeah, fair enough. I mean, you kind of answered the question: where does the money come from? Higher borrowing, spending cuts elsewhere, tax rises. You know, there is, if he's to stick to the mandate that was laid out and the manifesto that got Labour elected, he can't veer too far off that in the near term, at least, or else we're looking at a new general election.
Yeah,
And
I mean,
having had 7, so go on.
Sorry, it is really hard to see, any major spending plans coming without tax rises, but obviously there will be some tweaking around definitions and so forth. I think, we're definitely going to get that kind of thing. So, yeah, and then it's all about, sort of details around localism and devolving and Manchesterism and all that kind of thing. But that's probably too much
people
detail.
Overseas, people overseas, listeners probably won't care about that as much.
No.
So we can leave that for our political episode.
Yes.
We're coming to the end of the episode anyway, but I want to look at the week ahead. We touched upon the Fed, we touched upon Walsh. We got the FOMC minutes coming following their decision to leave rates on the hold, but it was Walsh's first meeting as chairman of the FOMC. Was there more hawkish debate than we realised? It's going to be one of the questions that people will ponder going in. HSBC thinks the minutes may reveal more discussion around whether rates need to go higher later this year. Toronto Dominion TD Securities angle is slightly different, less about imminent hikes, more about how restrictive policy really is at this moment in time. Either way, if the tone is firmer than markets expect, yields could see a move higher after what we've seen on the labour market front. Is that something you'd be watching intently, really, or do we know what we need to know from the June meeting?
Yeah, I think we pretty much know it's his debut. I think it's interesting just thinking about new Fed chairs, whether the market, history tells us kind of that the market wants to test the Fed chair, but then if you flip that around as well, whether the Fed chair tests the market. So he was trying to prove his independence, and therefore he did that through being more hawkish, and that sort of rubbishing forward guidance and everything like that then came sort of from that, which I think was interesting. We mentioned it off sort of mic that I think the outcome of the task forces will be interesting, but they're not till the end of the year. So it is interesting. He said don't prejudge the outcome, and then obviously markets did and priced in near-term hikes. So,
well, I mean, Bank of America, sorry to cut over you, Bank of America, this was pre-non-farm payroll, had made a call and we're looking for 3 rate hikes right before year end. And which seems a little bit, to me,
I think, it's really interesting. I think that, they react, right, a lot, and it probably gets lots of headlines, shall we say. The headlines aren't, the Fed sits on its hands to the end of the year, because that's really boring and kind of, not what anybody wants to hear. But potentially, through this period now, then, that is what happens. And he waits for these task forces and, inflation comes back down. We've seen peak inflation or not. I think just very quickly, I think it's really interesting that a lot of people talk about, say for the dollar, just support from Fed rate hikes, but they talk about, AI flows and equity flows and that type of thing, which I'm sort of slightly, and US exceptionalism and growth, and then inflation being greater than 2%, which is what Walsh said. I think we have to bear in mind what I just said about, him being first up, his debut, and wanting to, sort of just set out his sort of, his stand, if you like, and his independence, but then potentially we see things differently after the task force,
Absolutely. I mean, just to give Bank of America, because you've mentioned them, their side of the story, they see, again, this was before non-farm and this week's jobs data, they saw hikes in September, October, and December, which reversed the last year's 75 basis points worth of risk management cuts. They said the shift reflected a firmer labour backdrop with job growth back from above break-even, new Fed chair, and a persistent inflation problem. Core PCE is tracking towards 3.5%, nearly 70 basis points higher than a year ago, with services inflation remaining sticky as housing disinflation fades. While some inflation pressures are tied to one-offs like tariffs and energy, the breadth of stickiness suggests policy is not yet restrictive. I'd argue that President Trump brought in Walsh to be exactly the opposite and to be a dovish head of the US Fed. So there's confliction there in itself. One of the things that may help frame the narrative is this upcoming methodology change to PCE inflation. It's not happening for a while. I don't know. The only reason I brought it in is because, we talked about all these different initiatives he wants to bring in and everything else. And the reading of where inflation really is at. He's already said he doesn't really fancy core PCE in its current form as the best gauge of real inflation in the US. And he has other gauges that he looks at, other meters that he looks at. So it's a bit under the radar.
Yeah.
And it's expected to revise. Actually, if the calculations are correct, it could revise recent inflation lower rather than higher. So
yeah, I think sorry to interrupt, Harry. I think Goldman's had it 3.4 down to 3.2 and JP Morgan down to 3.3. So a couple of tenths lower than what we've seen.
Sure.
Yeah, but it is volatility. And again, I think, you just look at, say, UK employment data and people looking through that because it's not been great. Not that this, PCE hasn't been great, but just because we're getting these changes plus the task forces, then you kind of just think there's not an urgency to act just yet, I would say.
Yeah, absolutely. And timely implications for the Fed is the July 30th and August 28th PCE prints will use the old methodology.
Yeah.
September 30th release is apparently said to be the inflection point, and this means the Fed Reserve System could discuss these coming revisions in advance, but the official lower path wouldn't hit the data until after the September FOMC. So just to give it's a bit technical, but actually it matters for those looking at rate futures and pricing things, months out. And then we haven't even begun on the midterms, which comes in November, and we'll leave that for another time as well. As I said, we're coming to the end of the show. We've got Canadian labour market reports next week as well, just to give you a heads up. So it's a relatively quiet week, I think, ultimately, for a number of reports. For as I said,
we've got inflation the next week, haven't we? So it's quiet this week, and then inflation next week, right?
But then we head into summer really, and we start heading into the summer proper.
Yeah.
TD expects basically flat growth, job growth after May's solid gains, with unemployment rate steady at 6.6%, which would fit the broader theme of gradual cooling and not a collapse in the unemployment rate. Anything materially weaker could, however, shift BOC expectations. We've heard from Macklem, I think, this week as well. We've got RBNZ. They're likely to hike, according to a number of banks there, by 25 basis points to 2.5%. The reasoning is being put as simple. Inflation remains persistent. Growth is holding up better than many had feared, and policy was still below neutral, according to analysts. So focus won't be the move itself. It will be whether the bank signals more to come. And obviously that matters to the Kiwi dollar. So enough on the deck next week. And we've got Chinese inflation data as well, both CPI, PPI reports due out for those that look at the inflation rate from China. Listen, in background, markets still balancing slowing growth against sticky inflation is, I think, a global issue right now, and that's not to go. It's not going to go anywhere in the near term. But plenty to get your teeth into. For anyone who missed the start of this, you can go back and listen to us on any of the podcast platforms or on the socials. I'd like to thank Jamie Dutta of PIQ. Jamie, thank you for taking part.
Thank you very much, Harry. Great to be here, as I say. And some interesting sort of months ahead, I'd say. Yeah, definitely.
Absolutely. And we'll get you back on to discuss them as when they come up as well, because it's always great to have you on. Thank you, everyone, for listening. As I said, happy 4th of July for my American friends and listeners. Have a great, safe weekend and enjoy the football, in brackets, soccer, for those that are following the World Cup at the moment, as I am. So, yeah, have a great one, guys, and we'll see you on the other side.
LiveSquawk keeps serious market participants ahead of the news around the clock. Start your free trial at livesquawk.com.
Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.